People are still logging in, but I think we'll get going because it's 11 o'clock. So this week our guest is Michael Anderson, who's with Aquila European Renewables. So I think it's going to be an interesting chat. And then I've got a bit of news to talk about first. So 3 things that I've pulled out from this week. abrdn Japan, which is announcing a merger. BioPharma Credit, which put out a statement this morning, which probably needs a little bit of delving into, and Gresham House Energy Storage, which is trying to raise some money. abrdn Japan first. That chart doesn't look too awful. This is since it came into existence in 2013, so about 10 years ago. But as you can see, it hasn't really traded close to asset value across the whole of this period, and actually the performance has been great either. There it is in the context of its sector, which is the sort of Japan large cap, and it is by far the smallest of these, not helped by the fact that it's sort of been buying back shares since it started because of this wide discount. The discount today is at about 7%, but that reflects what the announcement that we've had recently. And a bit of history. So it, as I say, it goes back to 2013 when it was reconstructed from abrdn All Asia, which used to be in Asia, including Japan Trust. And because of the persistent discount, it introduced an annual discount triggered continuation vote. So they sort of measure what the discount is on average over the 90 days ended 31st of March each year. Last year, it just about squeezed through. So you think it was 9.7% on average, and the trigger is 10%. But this time it's 13.6. So the board knew that they were going to have to call a continuation vote, and they obviously were thinking, well, what can we do? Are we going to lose this? So the board said, well, look at this, we've been underperforming and we're too small. What are we going to, we need to do something. That's the returns from its fact sheet at the end of March. And you can see the extent of the underperformance there. So over 5 years, NAV 6.4 against benchmark of 19.5. That really isn't great. And discrete periods too, it has underperformed in most periods, so really not good. So the board, this is also proactively, it doesn't seem to have been encouraged in this, but it decided the best route was a merger with another Japan trust. And that's because it wanted to preserve exposure to Japan for investors, which makes sense because it thinks that that's an attractive market, and I agree. And also it decided that it wanted to find another closed-end fund because it reckoned that that's what shareholders wanted too. So it's chosen Nippon Active Value, which is really, I think, on the basis of the fact it's been the best performing Japanese fund since it IPO'd in February 2020. And you can see here, so this is in the small cap Japan sector. It's a £170 million trust now, so an influx of cash will push it up the market cap rankings a bit. And it's trading at a small premium to asset value, which always helps with these things, but I think, so I'll show you that it's not actually necessary. And it offers a bit of a yield as well because it's investing in these sort of unloved value situations in Japan. And there's the NAV returns. So it and ADI Japan have been the sort of winners recently, really. That sort of value opportunity stuff has been the way to make money. And that's the reason I think the board selected it. So from a procedural point of view, there's this thing we've talked about before. It's a section 110 under the Carthew Act, liquidation and merger, which just means that you can just do all this stuff without, it's sort of fairly seamless the way it works, but there's a few sort of meetings involved, but otherwise it's quite straightforward. You exchange your shares in abrdn Japan Investment Trust for shares in Nippon Active Value on the basis of their respective NAVs, but those NAVs are adjusted for the costs involved, which is why the formula asset value, FAV. Because you're doing it like that, doesn't matter really if Nippon Asset Value tends to slips to a discount. It won't really make a difference in terms of the way the whole thing works. There is a cash exit option, and you'd think that if NAVF is trading at a premium, then many people won't actually go for it. But I think that, as we'll see in a minute, that will be taken up. And that's at a 2% discount to asset value, or to formula asset value. And it helps that the manager of Nippon Asset Value, which is obviously going to get extra fees in the long run, will front up 800,000 of the costs associated with this. The costs are fairly chunky. Some of it is stamp duty, but the brokers actually tend to, and the other advisors tend to do quite well out of these things, the lawyers and people. And I think this is a reason, because they're all looking for things to do because they can't actually raise money, that we've seen a bit more of this merger activity now, because it's a way of them earning cash. One of the things that's normally cited for reasons why more mergers don't happen is that the directors lose their jobs. In this case, one director is going to roll over into the Nippon Asset Value board. So that they're obviously being quite sensible about this. They've sort of acted in shareholders' interest rather than their own, which is good. The Aberdeen Japan portfolio is fairly liquid, so they're going to be able to turn it into cash, I think, quite easily. But the holdings that they're going into in Nippon Active Value are not, and that portfolio is reasonably concentrated already. So there's going to be a sort of quite a big cash influx in there, and that's going to affect things. Given that, as I said here, that I think the cash exit option is going to be taken up in full, and these are the holdings from Bloomberg. They're not always completely accurate. For example, that Wells Fargo is the same thing as Allspring, but there we go. They just changed their name. But those two big players there, who own about 30% of the fund between them, are US discount players. So if they've got an opportunity now to get out at close to NAV, I think they're probably going to tick that box. And there may be other investors in there that would quite like to exit. So I think that 25% will likely flood out. But what you're left with is an influx of about 65 million. And it's already said at the end of April, we've got more cash than we normally would run with. And we know that that's not something that we ought to be doing. So they could have, I mean, assuming they don't invest anything straight away, they could have 100 million quid. So they are busy looking for things to do. So we may have a bit of a cash drag on the NAVF performance for a while, but in time they will invest that, and hopefully the whole thing will keep going. And as you know, we do love both of these approaches, this one and the Aberdeen AVI Japan opportunity. So I do think this is probably not a bad option. BioPharma Credit, that looks like it's been quite volatile if you look at this chart, but actually a lot of that is because most of its assets are in dollars, and so the sterling US dollar exchange rate is what's making this thing fluctuate. It's tended to trade at a premium until relatively recently, but that's not a very big discount. And it's a fund that we quite like, but there is always a risk to it because it's quite concentrated. So the discount slightly opened up recently, but it's still way narrower than any of its peers here. And it's largely because it hasn't really put a foot wrong since it got going. And it also pays with very attractive dividend yield. That's well over 7%. And the performance has been good too, as you can see here. So 5 years, it's generating returns of like 10.5% a year, which is obviously pretty chunky. Its second biggest investment, I say this is a very concentrated portfolio, so it's 15% of the fund, is a loan to a thing called Lumira DX. And they put out an announcement this morning about this. So Lumira, they lent 300 million to in March 21. It's a UK company, but listed on Nasdaq. Classic story that nobody wants to list in London, but there they are. And it's been listed since September 21, and it makes diagnostics. So it was a huge beneficiary of COVID. It didn't make the little test that you did at home, but it's basically sort of like a testing kit so that you can put them in doctors' surgeries and hospitals and things like that, and actually get test results quite quickly. And it's not just about COVID. They've got, I think, 12 different diagnostics things going at the moment, of which 3 have been approved by the FDA, and a whole bunch of them are being sort of tested, and some of them are sold over the counter in the EU. And so basically it's a decent business, but it's been heavily weighted towards COVID. So as COVID's kind of receded, its revenues have been shrinking. So in 2022, revenues down to 250 million from 420. And they did a big write-off of excess stock that they built up for in the terms of COVID. So that was a big loss that they finished there of 449 million. And they finished 2022 with $100 million in the bank. So they're obviously cognizant that they've got to do something to reposition their business in the face of this. And so on the 6th of April, they announced a kind of cost restructuring program, strategic refocus, cut the workforce by 40%, take a lot of the costs out. And you can see the need to get on with this, because the quarter-on-quarter revenue for Q1 2023 versus Q1 2022 was significantly lower. 22 million of revenue down from 126, recorded a loss of 44 million. The cash they're burning through, so they only had 68 million left. You can see that what that's doing to the share price. Anything like this, where investors are worried that things are going to run out of cash, has been heavily derated. So not really surprisingly. So the loan is supposed to pay back in March 24. It's been accumulating interest at 8% per annum. And the way that BioPharma structures these things, they get fees when they give you the money, they get fees when you give them the money back. I mean, it's all sort of like quite lucrative for them. But there is obviously a question about how this is going to be repaid. It says they're senior, so it's the first ranking thing on their balance sheet. So the equity investors are going to get wiped out before BioPharma Credit does. It's secured too against the business, so BioPharma couldn't end up running the whole thing if it couldn't pay the money back. But Lumira are trying to raise more equity, and they've got a filing out to raise $100 million. And that would make a massive difference to this. Or it might be that someone says, actually, this is not a bad little business that's looking quite cheap at the moment, maybe we'll buy it. And if somebody buys it, the likelihood is that BioPharma Credit will get paid out in full. And that's happened to it before, with something where there's sort of question marks, and actually the thing got taken out and they got paid back and actually turned out to be quite a decent investment. So I wouldn't be overly worried yet. Pharmacon is obviously on top of the situation, and they will provide updates as they appear. But there's a reason why these loans come with quite hefty interest rates, and there is a sort of risk involved. And so just something to sort of be cognizant of, I think, as we go through the next couple of months. Gresham House Energy Storage has been a great success story, as we all know, and the NAV marching up there. But the share price has stagnated in the last few months, in common with an awful lot of other renewable energy funds. And so it's sort of been trending down towards asset value. And you can see here, this is the whole sector ranked by the discount. And really, it's because Thomas Lloyd is suspended because of whatever it's done to itself in India. It's really the only fund now trading at a premium. And a lot of these things would love to raise more cash, but it's now probably the only one in a position to at the moment. So it's announced a 80 million fundraise, which is open to institutional investors, and retail investors already on the register. That retail offer is capped at 8 million euros because it's done at the sort of EU placing rule, which we obviously carried over to UK legislation and haven't tweaked yet. And it's one of the things that I'm really hoping that, since we've got Brexit, we might as well do something about and actually make this thing a lot easier. The issue price is 155.5, which is really quite close to where the thing is trading at the moment. And it's also not much of a premium to the NAV. You can see the difference in circumstances here, because when it last issued money, it was doing 145p relative to another 131, so a massive premium, but this is really quite narrow. And I think there's a slight question mark in my mind as to whether that NAV is actually slightly understated. Well, it definitely, they think it's going to move up. So this actually might be, I think it'd be hard pressed to argue it's diluted as issuance, but nevertheless, I think it's pretty nailed on that you would probably to actually gain something in terms of the NAV here, because it's got this operational stuff, and as these things become operational, that's what's been driving the NAV hikes, and it's got another huge chunk of projects that are under construction, but should all be operational by the end of 2023. So you've got some kind of built-in NAV influence here, because everything's valued on a discounted cash flow basis. And as these projects get risked by going into operational, then they can mark them up. So I think the NAV will be marked up. And they've also got a pipeline beyond that, which they can fund already. And then they've also got this 160 megawatts of stuff in California that they want to do. And this is really what they're raising the money to fund. So the 80 million will cover some of that. I think some of that will be debt. So I think that will give them enough money to do this. It's interesting because it's a departure. There's always a bit of risk associated with doing all kind of brand new stuff. So it's the first thing they do in the US. It's the first time they're doing 4-hour batteries. I didn't even know you could do 4-hour batteries. Apparently, this is a 4-hour battery storage project. It's the first time they've had the exposure to anything outside of battery storage, because it's going to be invested in the solar as well as the batteries. But actually, I think it's a very good investment. We like the US solar stuff. We don't really understand why the US solar funds are trading at big discounts. It's all kind of guaranteed revenue, really predictable revenue. So they get 1/3 of the revenues contracted for 20 years, another third they probably can be able to sell a PPA, which may be out for even longer than that. The other third comes from battery storage trading revenue, so trading the fluctuations in prices. And we know that Gore Street, because we had them on the show recently, we're saying what an attractive business that is in California and Texas and other places that they do it. And the really cool thing is, because of all of the Inflation Reduction Act stuff, you get US tax credits to cover 30% of the construction cost. So I think this is actually pretty attractive projects. They say that once it's commissioned, again, they think that's going to drive NAV higher. I think they ought to get the money. But it is touch and go given where the share price is. So we're going to be interesting to see what happens. So that is enough from me.